Good morning and welcome to the SERINUS Energy PLC investor presentation. Throughout this recorded meeting, investors will be in listen-only mode. Questions are encouraged, can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll. I would now like to hand you over to Jeffrey Auld, CEO. Good morning, sir.
Good morning. Good morning, everyone. Thank you for joining us. This is the investor presentation for the financial results for the 12-month ended the 31st of December 2023. My name is Jeffrey Auld. I'm the CEO of the business. I'm joined by Stuart Morrison, our COO, Vlad Ryboff, our CFO, and Calvin Brackman, our Vice President of External Relations and Strategy. Results for 2023. Production for the year averaged 642 barrels a day. The majority of that, 539 barrels a day, was from Tunisia, and Romania was 103 barrels a day. In Tunisia, we've been continuing to work hard in the south of the country, the Shweshasada fields. We've put pumps into these wells, and we've managed to increase the average pump life from 8 months to, we have one that's approaching 3 years. Our average is 24 months. That's incredibly important for the economics of these fields. You'll recall that Shweshasada is a very old oil field. So using the pumps to increase production and extract further oil from these fields is a very economic piece of our business. The installation of the artificial lift in Sabriya W1 was one of our big targets for 2023. I think we've talked a lot about when we got into that well and we found that drilling mud had been left behind to harden, that there was a lot of what can only be called junk in the well, and that very, very poor completion practices 20 years ago meant that we ran into obstructions that I think on estimate it would have taken us 63 days to mill through. The cost of the rig and the time of the crew for 63 days wasn't attractive, so we pulled out of the hole, and the tail end of 2023, we've planned and designed a sidetrack to go around that to get to the target area where we want to install that pump. Of course, that was pretty disappointing. This was the first pump that was going to go into the Sabriya field. Sabriya is the big field. 445 million barrels in place, of which 1.6% has been recovered. So getting pumps into this field, as we've done in Shweshasada, is very, very important. It's easier and faster for us to move in Shweshasada because we're 100% and we don't have a partner. So there is some requirement for us to work with our partner in the planning and get their approval. That has affected us on the Sabriya N2 well. Sabriya N2 was a well that was damaged upon completion when it was originally drilled. So it had never produced. It's 800 meters just north of our best producing well, the Win 12 well. This was an excellent target for us. The workover cleaned everything out, got in. We were on time, a little bit under budget, got in. And what we had wanted to do was to send solvent into the well and then acidize the well to clean out the old perforations. Our partner has not agreed to that, and we continue to be in discussions with them. Our partner has different capital objectives, so both we have to accrue the operating cash flow to do work, and then we have to make sure that they have themselves in the position to do work. The well is currently dewatering. It's at a very slow rate. We would like to, as I said, solvent the well and then acidize the well to increase that dewatering. We've seen in other wells in Sabriya that you dewater the wells and the oil then flows. So we very much believe that this is a valid well, and it just needs to be dewatered. We'd love to speed that up. We'd love to get that going, but our partner has yet to approve that. In Romania, we've extended the exploration phase of the Satu Mare concession. The concession is broken into two pieces. There's the commercial area around the Moftino gas field, and then the rest of it is considered exploration. And there's phased work programs for that exploration. The block itself is valid until 2032, so there's plenty of time to do work. And you'll recall there's 181 million barrels of prospective resources that have been identified by 2D seismic or by old wells that we would very much like to go out and extract from. So, Romania is the Moftino field is nearing the end of its natural life. As we move that business from a producing business back to an exploration business, we'd look to find another Moftino type gas field and produce that. And you remember Moftino, for about a $15 million investment, that field delivered just under $100 million of revenue to us. The situation in Romania is such that the windfall tax is very, very punitive. You will see when Vlad goes through some of the financial results, the impact in 2023 of a steeply declining commodity price across the board. The highest we sold gas in 2022 was just about $72 an MCF, and European gas prices are at about $8 right now. So there's been a big effect on that. With the windfall tax effectively being a revenue tax, we will not press with further increases in production until we have a better fiscal situation, because the windfall tax is taking a big haircut right off of revenue for us. We did in 2023 finally get the award of the 40% participating interest that had been outstanding with our defaulted partner since 2016. That was a very, very long process. It had to go through Romanian courts and then to the ICC. But it was great news that we now have 100% of that block. We drilled the Canar-1 well, which was not successful. Found gas, but not of commercial quantities. We've managed to turn that Canar well into a water injection well, and that is delivering us about $600,000 a year in cost savings through the disposition of our produced water. I'll hand over to Vlad to run through the financial highlights. Vlad?
Thank you, Jeffrey. On the financial highlights, our group consolidated revenue for 2023 was $17.9 million, and the gross profit of $2.5 million and EBITDA of $2.1 million. That is a considerable decrease on the comparative numbers of 2022, and the key drivers here is the declining production in Romania, but most importantly, the significantly lower commodity prices throughout the board during the whole of the 2023. Regardless of that, we continued our capital programs in Tunisia and Romania, and we invested about $5 million in Tunisia and $500,000 in Romania. The realized net price for the 2023 on average comprised $77.58 for the barrel of oil equivalent. And as you can see, in 2022, our realized price was $149 per barrel of oil equivalent. That had a knock-on impact on the operating netback, which decreased in 2023 and comprised $33.89 for the barrel of oil equivalent, a significant decrease again from 2022 of $107.59 for a barrel of oil equivalent. Our cash balance at the end of the year stood at about $1.3 million, and go to the next slide. That has got a bit of a visual on the financial performance. The revenue of $17.9 million and the cost of sales of $15.4 million. The cost of sales decreased compared to 2022, primarily due to the lower windfall taxes, and we managed to keep our costs throughout the board under control, regardless of high inflationary environments in all of the jurisdictions where we operate. Net income for the period is $13 million, and that includes the impairment of $7 million. We completed our impairment assessments throughout the board and throughout all cash generating units in Romania and Tunisia. In Tunisia, no impairment indicators were identified. In Romania, where we did identify the impairment indicators, predominantly arising from the lower gas prices, the depletion of the Martino gas field, reflecting on the natural life of the shallow gas fields, and the overall fiscal regime in Romania. Average production volumes, as Jeffrey mentioned previously, Romania decreased. Tunisia, we did report a slight increase, and we achieved a slight increase in the production in Tunisia of 539 barrels of oil equivalent per day, and we still carry the behind pipe gas volumes in Romania, which can be accessible depending on the fiscal regime and circumstances in Romania. Tunisia increased production, as I said, and well, I will not stop on the gas average realized price of gas in Romania and Tunisia, oil in Tunisia, because we just talked about that. Production expenses, the unit production expense is $34.38 per barrel of oil equivalent, rising in Romania and Tunisia, the two jurisdictions where we operate. And the operating netback in Tunisia comprised just over $40 a barrel of oil equivalent, and in Romania, it's a negative netback of $2.19 a barrel of oil equivalent. The funds from operations, the group managed to generate funds of just below 2 million, regardless of all of the circumstances and the fiscal regime in Romania. We remain in a strong position when we look at our corporate cash flow and the results which were reported for 2023. Romania remains cash generating, but loss making, and we used the funds of 1.3 million in Romania. In Tunisia, we generated net funds of $7.9 million, and we consumed $4.6 million at the corporate level, all of which resulted in 1.9 million in the net funds generated from operations during 2023.
Okay, thanks, Jeffrey. I think we're very proud of our excellent track record on safety and environment, which we continued throughout the year and will continue into the future as well. No lost time incidents is a record to be proud of, with our 3 producing areas and also in our offices. We take the opportunities we can to use solar at Martino, which we've done some more of in the last year, and will continue to do more in the future. We also make a real focus on monitoring gas emissions, other environmental parameters, which we have been doing for some time and will continue to do. We exceed local requirements. We have our own standards, and we're very proud to have kept those going. And we'll continue that throughout the coming periods too.
So very quickly in summary, we continue to generate cash flow. Cost control is a focus. Vlad showed the operating costs being static, given a very, very high inflationary environment. We've talked about some of the chemicals and some of the consumables having increased to the tune of 65%. That inflation has moderated like it has elsewhere in the economy. So 2023 was the year we really had to fight the inflation and keep that cost control in place. We keep talking about the large asset base. The large asset base gives us the opportunity, and the internally generated cash flow gives us the ability to go out and do that and not dilute our shareholders. The effect of that is, the progress is slower than we would like because we rely on the operating cash flow, and we have to accrue that cash flow to do the work. Existing funds are core to our business, and we match our capital programs to the available cash flow. Capital plans for 2024. These are focused on the 2 workover wells that didn't get completed in 2023, so the N2 and the W1. Those provide us with, we believe, excellent sources of production increase and therefore revenue and cash flow increase. And we would very much like to get on with those. The W1 well, we've talked about rig availability there. That's the big constraint. It looks like rig availability we will have in the fourth quarter. So the long lead items are being purchased. Import process into Tunisia is being executed, and all the purchase orders have been sent to the partner and approved to the partner. So we're well on track to get the W1 sidetrack going. It has taken time, but that's essentially rig availability. There's not very many rigs in Tunisia. There's nothing anyone can do about that. And when you're selecting a rig in Tunisia, you have to be very, very careful you get the right rig. There's clear performance and issues across the board with rigs. So waiting a little bit for the proper rig, for a rig that can do the job well on time and on cost is very, very important. In Romania, like I said, Moftino is coming to the end of its natural life. There is behind pipe gas, but to go in and spend the money to recomplete that gas when a windfall tax at a revenue level and an $8 gas price likely is best to wait until fiscal regimes and prices improve. There's no secret that when we were selling gas at very, very high prices, we were producing as much as we can, and moderating production at these low prices where we don't make very much money is clearly in our best interest. Preserve the gas for a better price environment, which we believe will be coming. So in Romania, we focused mostly on getting set for exploring for the next Moftino. We've talked about the multiple prospects we have, the 181 million barrels of prospects across that block. Moftino Nord and Canar 1 were not the best prospects. They were the prospects that were closest to the gas plant, where we could use the capital in the gas plant and immediately have revenue and cash flow. There are some very, very attractive prospects that we are pursuing now. And remember, that gas plant is skid mounted, so were we to have a discovery, we can move that gas plant to a new discovery. So we have a gas plant that has a 35-year life on it, that's produced for 5, almost 6 years, and it will be, it's an asset that we keep, and we want to use that capital to produce revenue. The longer-term exploration prospects in Romania are clearly what we view as the blue sky opportunity. There's a couple of quite sizable prospects. One in particular that's had a well drilled on it many years ago that had gas flowing to surface. So we know that there's a petroleum system there. We like the reservoir. We like how it looks. So that will be the next focus. We continue to really focus on cost control. 2023 was a very tough year with inflation across the board. We had managed to mitigate some of that by pre-buying some of our tubulars. We're in good shape now with long lead items for W1 coming through at a better cost environment. So we will continue to focus on capital allocation. As we accrue the cash flow, we'll allocate it to projects and keeping the cost control tight so that we have as much capital accruing to be able to put into the projects as possible. Forward plan, I think I've talked about the forward plans. I mean, Romania is clearly shifting to be an exploration block. And Tunisia, we very much like to get to work on that sidetrack. That sidetrack at the end of the year is the most important thing for us. We're now looking ahead into doing the artificial lift on Wind 12. Wind 12 is our best producing well. Getting a pump in there would be very, very prolific. Our partner has said that until we have a pump in another well, they're not prepared to approve moving forward with putting a pump in Wind 12. Where it's solely up to us, that would be where we would put the pump. But of course, we have a 55% partner, and they have a say in this as well. So that's the plans for 2024. And with that, I would conclude the presentation, and we can move to some questions.
Fantastic. Thank you very much indeed, Jeffrey, for the presentation and the wider team. Ladies and gentlemen, do please continue to submit your questions just using the Q&A tab situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions submitted today, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Jeffrey, if I may just ask you just to click on that Q&A tab and, just where appropriate to do so, read out your question and give your response or direct it to a member of the team, and I'll pick up from you at the end. Thank you.
Good, thank you. First question, when can we expect to see some positive, meaningful growth in revenues without operating costs continuing to escalate at fast rising levels? Well, look, we've talked about growth in revenue. Growth in revenue comes from commodity price, which we don't rely on, or increase in production. The increase in production, we've targeted places where we get the most bang for our buck. So the W1 well was that. Without the sidetrack, that was installing a pump into a well that had produced before, and turn that pump on and see how we did. The pumps in Sabrina are going to be our next meaningful production growth, and that we hope comes later this year. Operating costs continuing to escalate at fast rising levels. Well, that's not actually the case. Operating costs have risen. Our group operating cost was for 2023 $34.78 production expense, versus 2022 was $31.82. If you look at that on a per barrel basis, Romania is rising quite sharply, but that's just because the barrels are decreasing. The $31 in 2022 versus the $34 in 2023, I think is the result of some very dogmatic cost control in a very inflationary environment. So there is some natural inflation in that production expense that we are constantly fighting against. So we look to see growth in revenue from the pumps, which we've shown can work in Schwesch. We need to get those to work in Sabrina. And the cost control will continue. So we're not having operating costs escalating at fast rising levels. We're actually keeping operating costs relatively stable during the course of a high inflationary environment. There have been no operational successes in the last few years. In the board's opinion, would this be down to bad luck? No, I don't really believe in bad luck. Canar 1 and Moftino Nord were exploration wells. They have an inherent risk to them. I believe we correctly identified that risk, and we believe that the capital allocated to that risk was appropriate. But of course, exploration wells can do what Canar 1 and Moftino Nord did. I think we all have to remember we found gas in both of those wells. So the technical work to identify gas in reservoir was correct. The fact that the gas was not of sufficient volume to be commercial is possibly bad luck, but it's just one of the risks of exploration. Those wells certainly would not be economic to produce at $8 barrel gas. There was a debate back when we drilled them, when gas prices were much higher, if we should produce them. But the belief that putting in the tie lines and the bottom hole equipment would possibly be too high a risk, given the price of given where we were with commodity prices. Where does management see this business in 3 years' time? 3 years' time, I would hope to have 2 pumps into the Sabrina field, and if demonstrated that, we'd be able to accelerate that pump program. 3 years' time, I would very much hope that we had done some more exploration drilling in Romania. Remember, these are pretty shallow wells. We can drill them quickly. They're not that expensive to drill. So finding another field in Romania would be very positive for us. So I think in 3 years' time, if we had a couple of pumps running and showing that artificial lift in Sabrina was the way to go, if we can increase that 1.6% recovery factor to 2.6%, that's a lot of oil. You've got a 445 million barrel field. So it doesn't take a lot of increments in the recovery factor to make a very big difference. But it depends on the allocation of capital and how we generate operating cash flow. So The time is determined by how quickly we generate that operating cash flow to apply to our plans. The only success for current management was to sell off shares at half the market price to pay off debt. Is there anything positive investors have to look forward to under the current board of directors? Well, I think if we look back to the debt situation in 2020, the company was not able to pay its debts. The company was pressured by the bank to renegotiate. We took a lot of the revenue from Moftino to pay off the senior debt, but the convertible facility remained out there. We refinanced that at 50 cents on the dollar, and yes, we did have to raise capital from our equity holders to do that. However, the alternative was a company that could not finance its debts and was at risk of insolvency because of those debts. The company came out of that as a debt-free company and is able to do what it does now, which is allocate its capital and not dilute shareholders every year for G&A and for business. We are very prudent with our cost structure. We try to keep this business running as cheaply as possible, so that as much of the operating cash flow can go into our operations. Could you please give us an idea of how much the March lifting would be worth to us? We are actually loading the ship right now. It's in the port. We have the name of the ship. We had the marine tracker watching it show up. It'll take another couple of days to lift. We're lifting 69,800 barrels. Sorry, 69,800 barrels. The price we receive is the average of the months of lifting. So the last lifting we did in December, we do not have the final averages yet. They get calculated at the end of March. But it doesn't take, if you go onto your crude prices and get a Brent price, Saharan Light trades a little bit of a premium to Brent. So if you take the average Brent price for the months since December, you will roughly get us to where we're at for this lifting. So it's 69,800 barrels that we're lifting pretty much right now. If the dewatering is approved, how long would it take to action? Well, what we're looking to get approved is to go into the well, solvent the well, and then acidize the well to improve the flow. Until we do that, we don't really know how well we can get the water to flow and how much we need to draw off. What we know back in 2018, when industrial actions and social actions shut in all of the onshore production in Tunisia, we know that when the wells came back on, it did take us some time to pull the water out, and it differed for each well. So until we know the flow we can get out, we can't really make an estimate on how long it will take to get the oil. And the second part of this question is, why wouldn't they want oil to flow sooner? I think you're talking about ETAP, our partner here. I think they have, they're a partner in all the fields in the country. So they have their own capital, allocation decisions to make and where to apply capital. And I think this well just isn't high up on their list. It's high up on ours. We're very frustrated because, if we were sitting in an onshore field in North America, the trucks would have been down the road, and a week after we run into the issues with flow, you would have had the trucks at the field and you would have done this. It's very, very common, and it's very, very frustrating that our partner is not in a position to move this along. Why bother with Romania when they tax at revenue? Does the government not see that this discourages activity and revenue from them? Why bother with Romania? Well, There's a couple of reasons. Firstly, we have a nice little gas plant, which is a good chunk of capital that makes us good money when we can produce through it. Secondly, our people are assets. And rather than just shut in because we're in this particular period, that's not the kind of business that we want to run. We want our people to be there when when we need them. Does the government not see that this discourages activity? Yes, the government sees this. The internal auditor, the government auditor for the company, has done an audit on NAMR, which is the regulatory agency. And the audit came out with exactly the complaints we've been making. This is definitely discouraging activity. This is short-termism. This is taking as much revenue for a government that's in power now, but pretty much like the rest of the world is going to elections later this year. So there's a lot of politics in this. We've taken a very studied view of these politics and where we think things could move to. And we've also had very, very long conversations about the fiscal regime and the regime that would allow the onshore business in Romania to flourish. And remember, this is the country in Europe with the highest level of onshore reserves that is actively discouraging exploration in its country. So we believe that it's changing. It's slow to work with a government that is in an election cycle. And I'm not sure until the autumn we would get any resolution on some of our fiscal proposals. But this is a very, very punitive tax. In some cases, the reference price for the tax, which is calculated in Baumgarten, the gas price in Baumgarten, Austria, not in Romania. In some cases, that reference price that we pay tax on has been 2 times what we're able to sell the gas. So we've got a nice little position in behind pipe gas in Moftino that we would love to get on production, but if we're not making any money on it, then that gas can stay behind pipe where it is until such time as we see a better fiscal system. At that point, it's a couple of quick workovers to perforate the higher zones, to recomplete the wells for those higher zones and flow that gas through the gas plant, which is sitting right there. So, the effect of this tax, if it continues, is to shorten the economic life of the Moftino gas field, which we think has 2 years more life in it of good, solid production. So it's a government that is discouraging activity and looking for short-term revenue in an election cycle. What is the book cost of the gas plant? Well, the book value of the gas plant has been impaired in these accounts. The cost of the gas plant was just over $7.5 million. So the gas plant was worth $7.5 million because of the field it's sitting on and the life of that field. We've impaired that gas plant, so that gas plant is basically a book value of 0 with a $7.8 million cost. Remember, it's got a 30-year remaining life to it. So this is one of these nuances of accounting where the book value is not reflecting the future value of that on a different gas field. And that is the rest of the questions. That's the remainder of the questions. So I'll hand it back to you.
Fantastic. Jeffrey, thank you very much indeed for updating investors today. And of course, just to remind investors, any further questions that do come through, the company will have the ability to review those questions and we'll publish responses where appropriate to do so on the Investor Meet Company platform. Before redirecting investors to provide you with their feedback, which I know is particularly important to you, Jeffrey, if there's just a few closing comments, that'd be great.
Good. Look, thank you for joining us. Thank you for the questions. We appreciate everyone's time, and I hope that we've answered some of the questions about the results of 2023 and the plans we have for 2024. Thank you very much for attending.
Fantastic. Thank you indeed for updating investors. Now, please ask investors not to close the session. You should be automatically redirected to provide your feedback in order the team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of SERINUS Energy PLC, we'd like to thank you for attending today's presentation. That concludes the session, and good morning to you all.